Today's video is all about a bold statement from one of Wall Street's most well-known tech analysts. Dan Ives says this is a table-pounding moment, and that kind of language immediately tells you something important is happening in the market right now. In this video, we are going to break down what Dan Ives and 𝗣𝗟𝗏𝗧 were discussing on CNBC, including Apple's outlook, the current state of the tech and AI trade, and the sharp pullbacks we have seen across crypto. Dan Ives believes that 2026 could be a defining year for Apple, and his confidence around tech stocks during this sell-off really stood out to me. I am going to play the clip from CNBC first, and then I will come back and give you my own detailed reaction and breakdown of what he actually meant and why it matters for everyday investors. After that, we are going to take it a step further. I will walk you through 5 stocks that are flashing buy signals right now and explain why I think this moment could be a major opportunity if you know where to look. If you find value in these kinds of market breakdowns, hit the like button, share it with someone who follows the markets, drop your thoughts in the comments, and subscribe to the channel so you do not miss the next important investing update. Now let's hear what Dan Ives had to say.
Dan Ives of Wedbush Securities, 𝗣𝗟𝗏𝗧 of 𝗗𝗑�M Financial. Great to have you both here. Dan, you just mentioned Apple right before the break, so I want to get your response to this.
Look, if you look European regulators and Apple, that's for them like drinking a cappuccino. I'm not concerned at all in terms of any issues in Europe. Look, to some extent, Apple, they're on the offensive. And I think the reality is when you look at the Google numbers, you look at what they're now starting to do with AI, look, that's sneakily, that's actually been a really good stock over the last few weeks. And I believe this is going to be the year. If you look, Google in 2025 will be Apple in 2026 in terms of what I believe. Look, I think AI, $75 to $100 per share. The consumer AI revolution, I know Jeff has talked about it as well. The consumer AI revolution goes through Cupertino.
Jeff, your thoughts on this?
Well, I agree with Dan. And what's so fascinating last year, Morgan, is that we saw that great rotation internally of the Mag 7. What do we see? We saw NVIDIA profit taking. We also saw Meta profit taking, and they bought the 2 laggards. If you remember going back to April around the trade tariff lows, that's when Google and Apple were essentially laggards. So that was a great opportunity. 1-year perspective, you're seeing Google up over 60%. And I get excited about where Google can be the tip of the spear moving forward. If you think about just Gemini, you just talked about Gemini, more active users, 750 million users. They're now processing 10 billion tokens per minute. If you don't know what that means, all it means is that they are growing. But the best part about that Gemini vertical, Morgan, is that the serving costs to process those units are down 78% in 1 year. So for a company that just went over $400 billion in revenue for the first time, I get giddy about Google.
I also think, Jeff wearing a pink tie is bullish as well. But the thing...
It's for you, buddy. I wore that for you.
It is, but I think that's a bullish sign as well. But the one thing I'd say is that he's nailing it. Because I think the reality is if you look at the pieces of the puzzle that are now forming, from hyperscalers to CapEx to what we're seeing on the monetization with names like Palantir. And to me, you come out of earnings season more bullish. Now, look, the white knuckles that we're seeing, the software apocalypse that's essentially happening, I view it as opportunity. We're going to look back, just like a year ago, DeepSeek moment and Liberation Day. Yeah. We're going to look back at this moment as what I view as a table pounder time to own the names that I think have just really been massively sold off.
Okay, so in light of this, show of hands here, gentlemen. Who thinks software is entering a new era that we've never seen before, given the sell-off, and that AI is truly going to disrupt it versus just a re-rating happening right now?
I'm like half of an arm, Morgan. I think what's happening here is it's an oversold condition. Look at IGV. They've had almost $4 billion in outflows. It's overdone, exaggerated. In every move we're seeing, anything with tech, they even saw the algos sell Google on the earnings report tomorrow because they're just selling everything. So it's indiscriminate selling, which to Dan's point provides opportunity for some of those great software names.
Did Palantir help trigger this sell-off?
Look, if you look at Palantir, that was a quarter for the ages relative to that earnings. I think to some extent, Palantir is showing how they're disrupting that software model and they're transforming with essentially no direct salespeople. But to me, we're going to have a software rally for the ages. We've talked about it. I think it's way oversold. Now, look, is it disruptive AI? Yeah. But when I look at Salesforce, You look at CrowdStrike, you look at Microsoft, you look at Oracle and other ServiceNow. Yeah, exactly. I mean, look, again, it's a disruption. We're going to look back and being like, the market got this one wrong, and that's what we're talking about. All
right, I want to get your thoughts on another area of momentum in this market, and that's been cryptocurrencies, because obviously we've seen a lot of selling there too. So 𝗗𝗧 𝗖𝗢𝗗𝗘 was tracking this because we get Strategy after the bell, and obviously this is a name that's been hit very hard on the move lower in Bitcoin. Take a listen.
So, Morgan, the key number to watch with Strategy is its discount to net asset value. The stock is now trading below the value of its Bitcoin holdings. Roughly $38 billion is its market cap against $52 billion in Bitcoin on the balance sheet. And BTC itself is now trading below Strategy's average acquisition cost. That is a sharp reversal from the persistent premium that powered the Michael Saylor playbook for years.
All right, that was 𝗗𝗧 𝗖𝗢𝗗𝗘. Jeff, I want to get your thoughts on this because, and it's not just the cryptocurrencies themselves, it is the strategies of the world. Bitmine, there are a number of them that have become these cryptocurrency treasury companies, and there are a lot of unrealized losses the lower these prices go.
No, you're right. And cryptocurrency overall is in a gut check moment. But I look at Strategy, it's a broken chart. It's down 72%, Morgan, from all-time highs. And what's really dismal about the balance sheet, there's only about $200 million in cash on hand. I know they have tons of Bitcoin valuation, but at the end of the day, what we're seeing here with Strategy, it's a falling knife. It broke the 50-day moving average at 165. So I'm a little at loss of words. If there's an entry point here, I really want to see stabilization. I don't know if it comes from earnings, but I hope it does.
Dan, I want to get your thoughts on this, especially because you're chairman of 𝗗𝗏 Holdings of the board there, which is accumulating WorldCoin, which is the native token of the blockchain that's used in Sam Altman's biometric identity verification startup.
Look, I mean, I'd say right now, if you look for, like, you know, Jeff, it's a gut check moment for crypto. Saylor's the poster child, right? I mean, in other words, it's a very important conference call, how he handles it in terms of Bitcoin, and of course, what we're seeing with Strategy in terms of MNAV. Look, to me, it just comes down to, like, it's a gut check moment for crypto, but this is not the end. This is a digestion period. You know, we're bullish overall. You know, as I've talked about, disruptive technology has happened in tech, crypto, everything that's selling off. But ultimately, these are the opportunities, and I think that's what, you know, to me, that is why this is an important moment for the market.
Just to add on really quickly, Morgan, what's interesting about crypto, at times of distress, it turns into a cash machine and becomes way overcorrelated and exaggerated to the overall global macro sentiment. So it's in a cash machine moment right now, but I think it's going to find some stabilization.
The conversation starts with Apple and European regulators, and Dan immediately downplays the regulatory noise. He basically says this is routine for Apple, almost like muscle memory at this point. His point is that regulatory pressure in Europe is not something that derails Apple's long-term story. And honestly, I agree with him here. Apple has dealt with regulators for years, and it has never stopped them from printing cash or controlling their ecosystem. If anything, Apple has learned how to operate with regulators watching closely. What I found more interesting is how Dan pivots quickly from Apple to Google. He makes a bold comparison, saying that Google in 2025 could look like Apple in 2026. That is a big statement. What he is really saying is that Google is quietly becoming the next dominant AI platform in a way the market may be underestimating. Over the past few weeks, Google's stock has actually been strong, and that strength is tied directly to AI execution, not hype. Dan also throws out something very important when he says, I could be worth $75 to $100 per share for Apple. That tells you how massive he believes the consumer AI opportunity is. In his view, the consumer AI revolution runs straight through Cupertino, and my personal take here is that this is where Apple is still misunderstood. People focus on Apple being late to AI, but Apple does not need to be first. Apple needs to be embedded. When Apple rolls out consumer AI at scale, it will be frictionless, invisible, and monetized in ways people are not fully pricing in yet. Jeff Kilberg backs this up by talking about the rotation within the so-called Magnificent Seven. Last year, investors took profits in Nvidia and Meta and rotated into laggards like Google and Apple. That rotation mattered. Google being up over 60% in a year is not random. Jeff highlights Gemini as a key driver, with 750 million active users and 10 billion tokens processed per minute. That number sounds technical, but what it really means is usage is exploding. What stood out most to me from Jeff's comments is the cost side. He points out that Gemini's serving costs are down 78% year over year. That is huge. This is where AI stops being a science project and starts becoming a profit engine. Lower costs plus massive scale equals operating leverage. For a company that just crossed $400 billion in revenue, that is why he says he gets excited about Google. And honestly, this is one of the most bullish data points in the entire interview. Then Dan shifts the conversation towards software and what he calls the white-knuckle moment we are seeing right now. He uses dramatic language like software apocalypse, but he immediately reframes it as opportunity. He compares this moment to what we will look back on as a table-pounding opportunity. In other words, this is when fear creates mispricing. I personally think this is where a lot of investors get it wrong. When software stocks sell off together, people assume something structurally broke. But Dan is arguing that this is indiscriminate selling driven by algos, flows, and fear, not fundamentals. Jeff reinforces this by pointing out massive outflows from tech ETFs and how everything with a tech label is getting sold, even good earnings. That moment where Jeff says algos sold Google on earnings is telling. That should not happen in a rational market, but it happens in panic-driven markets. And historically, those moments tend to reward investors who stay patient and selective. Palantir comes up as a trigger point, and Dan calls it quarter one for the ages. He highlights how Palantir is disrupting the traditional software model by scaling without a massive direct sales force. That matters because it speaks to efficiency and margins in an AI-driven world. In my view, Palantir is becoming a case study for what next-generation software companies might look like. Dan then lists names like Salesforce, CrowdStrike, Microsoft, Oracle, and ServiceNow, and he makes a key point. AI is disruptive, yes, but disruption does not mean destruction. The market is treating this like old software models are dead, but Dan believes we will look back and say, the market got it wrong. I tend to agree. Incumbents with distribution, data, and customer relationships usually adapt better than people expect. The conversation then pivots to crypto, and this is where the tone shifts. Jeff is much more cautious here, especially around strategy. He calls it a broken chart, down 72% from highs, with very little cash on hand relative to its Bitcoin exposure. He uses the phrase falling knife, which is never what you want to hear as an investor. I appreciate Jeff's honesty here because it contrasts with the tech optimism earlier. Crypto is clearly in a gut check moment. Strategy trading below the value of its Bitcoin holdings signals that the market is questioning the leverage and structure of these crypto treasury companies. Dan, on the other hand, takes a longer-term view. He acknowledges the gut check but frames it as a digestion period, not the end. He lumps crypto in with disruptive tech broadly, saying everything disruptive is selling off at the same time. His message is consistent. These moments feel painful, but they tend to create opportunity. My personal view on crypto sits somewhere in between. I do not think this is the end of crypto, but I also think leverage-driven strategies are being exposed. Long-term innovation will survive, but weak balance sheets and aggressive financial engineering will not. When you zoom out, the entire interview is really about cycles, fear versus fundamentals, short-term selling versus long-term transformation. Dan Ives is essentially saying that AI, software, and disruptive tech are not breaking. They are being repriced temporarily, and historically those moments tend to favor investors who can separate noise from signal. For me, the biggest takeaway is not a specific stock pick, but the mindset. This is a market that is forcing discipline. Not everything is a buy, but not everything is broken either. And if history is any guide, these uncomfortable moments are often where the next leg higher quietly begins. Now, let's dive into the 5 stocks that are flashing buy signals right now. The first stock flashing a buy signal right now is Apple, ticker AAPL. Apple is one of the most misunderstood stocks in the market today, not because investors doubt the quality of the business, but because many people underestimate how deep and durable its ecosystem really is. Apple is not just a hardware company. It is a consumer platform with recurring revenue streams that rival the predictability of enterprise software businesses. At its core, Apple controls the most valuable consumer ecosystem in the world. Over 2 billion active devices are in use globally, and that installed base creates a powerful flywheel. Every new device sold strengthens the ecosystem. Every service layered on top increases switching costs. And every incremental improvement in user experience reinforces brand loyalty. What makes Apple especially compelling right now is the transition it is undergoing from a hardware-centric growth story to a services-driven cash flow machine. Services revenue includes things like App Store fees, Apple Music, iCloud, Apple Pay, Apple TV Plus, and a growing portfolio of subscription-based offerings. These services carry much higher margins than hardware and provide more stable revenue through economic cycles. Another critical factor is Apple's positioning in artificial intelligence. While Apple does not market itself as loudly as some competitors in AI, its strategy is fundamentally different. Apple focuses on on-device intelligence, privacy-centric AI, and seamless integration across hardware and software. That approach fits perfectly with its brand and its massive installed base. The company is also uniquely positioned to monetize AI through hardware upgrades. As AI capabilities increase, consumers will need more powerful chips and devices, creating a natural upgrade cycle. Apple controls its silicon roadmap through its custom chips, which gives it an enormous advantage in performance optimization and power efficiency. From a financial perspective, Apple continues to generate massive free cash flow. That cash flow supports aggressive share buybacks, a growing dividend, and continued investment in innovation. Even in periods of slower revenue growth, Apple has demonstrated the ability to expand earnings per share through capital returns and operational efficiency. In my view, Apple's current setup represents a classic example of a high-quality compounder going through a sentiment reset. Investors have rotated away from mega-cap tech at various points, but the underlying business fundamentals remain strong. When you own Apple, you are not betting on one product cycle. You are owning a toll road on consumer technology spending. Before we move on to the next stock, I want to quickly thank today's sponsor. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let us move on to the second stock on our list. Toll Brothers, ticker TOL, operates in an industry that many investors misunderstand and often underestimate: residential home building. Unlike most home builders, Toll Brothers focuses on the luxury segment of the market. This positioning gives the company pricing power, margin resilience, and a customer base that is less sensitive to short-term interest rate fluctuations. Toll Brothers builds high-end homes in desirable locations, often near major employment centers and affluent suburban markets. These are not entry-level buyers stretching to afford a home. These are higher-income households with strong balance sheets, significant equity, and long-term housing needs. What makes Toll Brothers particularly attractive is how it manages its inventory and land strategy. The company is disciplined in land acquisition, often controlling land through options rather than outright ownership. This reduces risk during downturns and allows flexibility when market conditions change. Housing demand in the United States continues to be structurally undersupplied. Years of underbuilding following the financial crisis created a deficit that still has not been fully addressed. Even with higher interest rates, household formation, demographic trends, and migration patterns continue to support demand for housing, especially in the higher-end segment where supply is more constrained. Toll Brothers has also diversified its business beyond single-family homes. It has meaningful exposure to luxury condominiums, urban developments, and rental communities. This diversification provides additional revenue streams and reduces reliance on any single housing format. From a financial standpoint, Toll Brothers has demonstrated strong return on equity, solid margins, and prudent capital allocation. The company has been actively returning capital to shareholders through buybacks while maintaining a healthy balance sheet. In my opinion, Toll Brothers represents a misunderstood opportunity. Many investors lump all home builders together and assume they rise and fall with mortgage rates. In reality, Toll's customer base, pricing power, and operational discipline make it far more resilient than the average builder. When housing sentiment turns negative, that is often when the best long-term opportunities appear. Let us move on to the third stock flashing a buy signal. Sterling Infrastructure, ticker symbol STRL, is not a household name, but it operates in one of the most important and durable areas of the economy: infrastructure development. The company provides specialized construction services focused on transportation, e-infrastructure, and residential construction. What sets Sterling Infrastructure apart is its exposure to long-term secular trends. The United States is undergoing a multi-year infrastructure investment cycle driven by federal spending, population growth, and the need to modernize aging systems. Roads, bridges, data centers, and residential developments all require skilled construction services, and Sterling is positioned directly in that path. One of the most attractive aspects of Sterling's business is its focus on higher margin, specialized projects rather than commoditized construction work. By targeting complex projects that require expertise and scale, the company can generate better margins and more predictable cash flows. Sterling has also benefited from the explosive growth in data center construction. As cloud computing, artificial intelligence, and digital services expand, demand for data centers continues to rise. These projects require extensive site development, electrical infrastructure, and specialized construction, all areas where Sterling has capabilities. Financially, Sterling Infrastructure has shown strong revenue growth, expanding margins, and improving returns on invested capital. Management has been disciplined in bidding projects, focusing on profitability rather than chasing volume. That discipline is critical in an industry where poor project selection can destroy shareholder value. In my view, Sterling Infrastructure is a classic example of a company benefiting from multiple long-term tailwinds at the same time. Infrastructure spending, digital transformation, and housing development are all working in its favor. While construction may seem cyclical, companies with the right project mix and execution discipline can compound value over time. Now let us turn to the fourth stock on our list. GE Aerospace, ticker GE, represents a focused, high-quality industrial business following the restructuring of General Electric. By separating its aerospace operations, the company has created a pure-play aviation business with strong competitive advantages and long-term growth visibility. GE Aerospace is a leading supplier of jet engines and aviation services for commercial and military aircraft. The company benefits from long product life cycles, high switching costs, and recurring service revenue tied to engine maintenance and overhauls. One of the most important aspects of the aerospace business is the aftermarket. Once an engine is installed on an aircraft, the manufacturer generates decades of high-margin service revenue. This creates a powerful annuity-like revenue stream that grows as global air travel increases. The recovery in global travel has been a major tailwind for GE Aerospace. As airlines increase flight hours, demand for maintenance, spare parts, and engine overhauls rises. This drives revenue growth and margin expansion in the services segment. GE Aerospace also benefits from defense spending, providing engines and systems for military aircraft. This adds diversification and stability, especially during periods of economic uncertainty. From a financial perspective, the standalone aerospace business has clearer transparency, improved margins, and stronger free cash flow generation compared to the old conglomerate structure. Investors can now evaluate the business on its own merits without the complexity of unrelated segments. Personally, I see GE Aerospace as a prime example of value being unlocked through simplification. By focusing on its strongest business, the company has improved execution and investor confidence. Aerospace is a long-cycle industry, and owning a leader in this space can provide steady compounding over time. Now let us move to the fifth and final stock flashing a buy signal. Royal Caribbean operates in the global cruise industry, a sector that has gone through extreme volatility over the past several years. Despite that volatility, Royal Caribbean has emerged as one of the strongest players in the space with a compelling long-term growth story. Cruising remains one of the most cost-effective vacation options for consumers. As travel demand continues to normalize, cruise lines benefit from strong booking trends, pricing power, and high onboard spending. Royal Caribbean has positioned itself at the premium end of the market with innovative ships and unique destinations. The company has invested heavily in new ship designs that offer better fuel efficiency, higher onboard revenue, and improved guest experiences. These investments create differentiation and support higher returns over time. Royal Caribbean, ticker RCL, has also developed private destinations that enhance the value proposition for customers while capturing more of the vacation spend. These destinations increase customer satisfaction and profitability while reducing reliance on third-party ports. From a balance sheet perspective, the company has been focused on deleveraging following the pandemic. As cash flows improve, Royal Caribbean has the opportunity to reduce debt, strengthen its financial position, and increase equity value. In my view, Royal Caribbean represents a recovery and growth story combined. While the industry faced significant challenges, the long-term demand for experiential travel remains strong. Companies that invested through the downturn are now positioned to benefit as conditions normalize. When you step back and look at all five of these stocks together, a common theme emerges. These are businesses with durable competitive advantages operating in essential sectors of the economy. They are not dependent on short-term trends or speculative narratives. They are positioned to generate cash flows and compound value over time. Market volatility often creates the best opportunities for long-term investors. When high-quality businesses flash buy signals during periods of uncertainty, it is often a sign that sentiment has diverged from fundamentals. That divergence is where disciplined investors can find opportunity. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Before we wrap up, I want to ask you a question. When you compare businesses like Apple and 𝗣𝗟𝗨𝗦 with more cyclical names like Toll Brothers and Royal Caribbean, which do you think offers the best long-term risk-reward and why? Let me know your thoughts in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.